dangerous four-letter word. All of us opt for various type of loans during different stages of life. Home loan makes it affordable to buy our dream house. Car loan fulfills our goal of owning a car. Borrowing is neither good nor bad. It depends on the financial profile of the borrower. Similarly, debt, the four-letter word, is essential for business for their expansion and operational requirements. Debt for business can help boost profits. However, excessive debt coupled with bad management at bad times can lead to bankruptcy. As a small investor, a simple ratio called debt to equity ratio can tell you from far whether the company's debt is low or high. Debt to equity ratio is the ratio of all the borrowings of the company and shareholders' investment. If debt to equity ratio of any company is more than 1 and increasing, it should definitely ring an alarm bell. Just like return on equity, debt to equity ratio is also available on Google and must be seen for past few years to see what the trend is. A debt to equity ratio of less than 1 or decreasing is a positive sign. Just for an anomaly, all the lending businesses such as banks and non-banking finance companies have debt to equity ratio much more than 1 because the business is based on borrowing money at lower interest rate and then lending that money at higher interest rate. Lesson number 5. Stocks to avoid. Charlie Munger, the right-hand man of Warren Buffett, who is currently 97 years old and known for his words of wisdom, said, "All I want to know is where I'm going to die, so that I don't go there." Thus, it is prudent to know in stock market the stocks that you must avoid at all costs. These are high debt companies. The easiest way to find them is by looking at the debt to equity ratio mentioned above. During good times, the bad managers of the company become over optimistic and fund the growth with huge debt. When the cycle turns, the debt becomes unmanageable. The business along the stock price then suffer. Second, low promoter holding. A company in which the owners of the company do not have a majority stake, which is called skin in the game, you must avoid it. If the company has low promoter holding, that does not mean it will do bad. But in the company where promoter hold big stake, that means that the wealth of the owner is directly dependent on the functioning of a business. Like a small investor, the owner of the company cannot enter or exit into the stock of the business with a click of a mouse. There are legal filings which happen if owner wants to sell or buy their stake. Shareholding pattern of all the companies are updated quarterly, and increasing promoter holding is a good sign, and consistently decrease in promoter holding should make you alert. Stay away from small companies where promoter holding is less than 20%. Third, high promoter pledging. The owners of the company can keep their stake in the company as collateral and avail loans from the bank. This activity is called pledging of shares. Sometimes this loan can be for operation of business. However, sometimes the loan can be for personal reasons as well. Pledging is generally the last resort for promoters to avail the loan. If the promoters are not able to meet the obligations of loan in time, then banks have the right to acquire shares of the promoters and sell it in stock market to convert it into cash. The excessive selling of stocks can further hit the stock price. Prasanjit says that as a conservative small investor, it is better to avoid these stocks completely. Fourth, stock touching new lows. Unless and until you are confident about prospects of the business, avoid stocks which are touching new lows year after year. This can be a red signal. This will soon be indicated by bad fundamental ratios and bad numbers of the company. If you have in-depth knowledge about the business of the company and are sure that everything is good, then these can be opportunities of outsized returns. But more often than not, most of the stocks like these are graveyards for investors who are lured by the word outsized returns. Fifth, too much popular stock. When the stock becomes too popular and everyone buys it, it becomes overpriced and gets very risky for our hard-earned investment. When everyone talks about investing in Tesla, doubling their money in tech companies, stay away. The most popular an investing instrument becomes, the more likely it is to underperform in long term. Tech companies at the peak of 2000 dot-com bubble real estate company at the peak of 2008, to pull out a few examples of such kind. Sixth, the costly acquisition. To scale up business to achieve faster growth rate, many companies opt for costly acquisitions. Many times, costly acquisitions with external debt and inability to turn around the company to profits causes enormous wealth destruction. Sri Renuka Sugars, a sugar company, acquired two Brazilian large sugar manufacturing loss-making plants in 2010. The acquisition increased their debt 5 times in 2 years. The stock price of Sri Renuka Sugars in 2010 was 120 Indian rupee. Today, after more than 10 years of acquisition and inability of company to turn the Brazilian plants into profit, the stock price of Sri Renuka Sugars today is just 12 Indian rupee. Capital erosion of more than 95%.
Let's have a quick recap. The first step to avoid loss as a small investor is to stay away from trading. Trading is a full-time job and needs enormous knowledge of macroeconomics, information about business that everyone does not know. Be aware of the trading gurus and stock tip providers who promise you 100% guaranteed returns of unimaginable profits. Profits and sales number of the company can be easily manipulated. However, what cannot be manipulated is the cash in bank. The first thing that an investor must look at in a company is its return on equity. It is the ratio that tells about the efficiency of business. Keeping all things same, return on equity less than 12 is poor, 12 to 15 is average, more than 15 is good, and more than 20 is exceptional. Look at the return on equity data for past few years. Economic moat is the competitive advantage that a business has, which give the business an edge over its competitors. This may be due to better product, technology, brand, networking effect, etc. An economic moat is completely subjective, but some indicators of it can be high return on equity and high operating profit margins. Buying a business with economic moat is a big protection to downside risk. Debt is the most dangerous 4-letter word. Unmanageable debt can bankrupt a company. Debt to equity ratio is a good indicator of the borrowing position of the company. Debt to equity ratio of more than 1 and increasing is a serious red flag. Small investors must avoid stocks which have high debt, low promoter holdings, company where the owners of the company have pledged their share, company which is hitting all-time lows, the most popular stock that every news channel, your friend and taxi driver is talking about, and last but not the least, the stock of the company that makes costly acquisitions. That's it guys. If you liked the video, don't forget to like and subscribe. You can check out my lessons from Benjamin Graham's Intelligent Investor 2. I will come again with a summary and lessons from the new book on investing or finance soon. Until then,